Hello, and welcome to Wealth Matters, where we discuss the opportunities and challenges of preserving and managing wealth. This show is presented to you by Frankel, a fiduciary law firm dedicated to resolving disputes involving your wealth, whether through your will, your trust, your business, or your investments. For news, pictures, and tips, go to our website at gaslowitzfrankel.com or follow us on Twitter at Estate Dispute. Our show's hashtag is Wealth Matters. Your hosts today are Robert Port and Craig Frankel, and we're talking about what charitable advisors need to know in 2020, or said differently with 2020 hindsight, what should clients talk to their charitable advisors about?
And now it's time to introduce our guests. We are pleased to have with us today Michael Van Cise and Kathryn Baldwin-Hecker, both partners with the law firm of Arnall, Golden, Gregory, LLP. So Michael and Kathryn, let's get started by asking each of you to tell our listeners a little bit about yourselves, your firm, and your practice areas. Kathryn, you first.
Sure. Well, thank you for having us. We're excited to be here. I've been with Arnall Golden for almost 8 years now and focus exclusively on ultra high net worth clients and dealing with all matters related to their wealth, particular business planning, charitable successions planning. And we've also been expanding a lot into international planning lately. We found that that's kind of a big area for a lot of our Atlanta clients. And in addition to practicing in Georgia, I'm also licensed in South Carolina, so I've been doing a lot of work there as well.
And Michael?
So I finished law school in 2006, lateraled to Arnall Golden in 2010. Have focused my practice. Most of our clients are business owners. We also work with clients with intergenerational wealth. As Kathryn said, have done a little bit more international estate planning. We also work with people in the sports and entertainment area and have an industry focus on that as well.
So let's start kind of easy. So I heard Kathryn say that your clients are ultra high net worth clients, and I heard Michael, you say that a lot of your clients are business owners or intergenerational wealth. I want to talk about that because I find it fascinating. But before we get there, I'd like to talk a little bit about how the charitable deduction and giving to charity has changed since the new Tax Act. So I'm going to let either one of you answer the question, but the first question is going to be, what did the recent Tax Act do, good or bad, to giving to charities?
So for high income earners, maybe the change isn't affecting them, but the biggest change was the increase in the standard deduction to $24,000. So that means if all of the itemized deductions, so the various things like your state and local taxes, your charitable deductions, home mortgage interest is the other big one. If those things aggregated together don't total more than $24,000, then it's more advantageous to take the standard deduction. So in other words, your gift to charity didn't lower your tax bill, and if you just kept that money, you would have still had the same tax deduction. So that's a pretty significant change for many people that don't have large mortgages, make large charitable gifts. Probably for high income earners, maybe not a big change if you were making significant charitable gifts anyway. But that affected, I think, the number of people that will itemize deductions is significantly lower. I don't remember the actual statistic, but it was a big change.
It's a much smaller.
Well, I actually looked that up. The statistic now is, I don't know what it used to be, but 85% of all taxpayers, what was the prediction, will now itemize. And I'm very curious to see what happens now that we finish the tax year and accountants and people like you are now looking at tax returns for 2019.
So one of the questions I have, and there's been some media reporting on this, is whether those changes affected people's generosity. So do you have any sense, given your practice areas, as to whether those tax changes have affected what people are giving to charities? Because we have folks in the giving community, in the charitable community who expressed some concern that folks aren't incentivized, if you will. So what's your take on that?
So before I went to law school, I worked in the nonprofit fundraising arena, and I think even in, that was 20 years ago, and there were concerns then that changes to the tax law might affect how people give. I think surveys that have been done have consistently showed that when people prioritize or say why they gave to a given charity, tax benefits is like number 15 on the list. It's people are giving to mission-driven organizations because they value what those organizations do, not for the tax benefit. Oftentimes,
is that true for high wealth individuals? The same for what I would call the everyday giver?
I think some of it depends on, why they're giving. If it's a very high net worth person who, say, had a large liquidity event that particular year, they might make a much larger gift than they ordinarily would and would be very concerned about the tax benefits in that case. But if it's somebody who's making their traditional gifts to, pick your large Atlanta institution of your choice, and they normally give, say, at like a $20,000 level every year, they'll probably continue to do that and not, be as concerned with the tax ramifications there.
There is a survey out that the majority of giving overwhelmingly in the United States is religious giving, and that has not changed.
Right.
It's really the non-religious giving where we need to be looking.
So one of the things we've been talking about, and you just alluded to this, Kathryn, is the fact that at a certain level, folks who give meaningful amounts will probably continue to do so, and by doing so they may meet the deductibility limits. How about those folks who are more, if you will, in the middle class? And one of the things I'd like you to talk about for our listeners is what's called a donor advised fund. And can you tell our listeners what that is and how that goes into the topic we have today?
Sure. So a donor advised fund is a public charity. It's essentially, there are many out there. Many of the money management firms have their own donor advised fund. Both Kathryn and I have created donor advised funds, so you can I'm not. I couldn't be a client of mine. I'm not.
What Michael is saying is that he's 15 years old and Kathryn's 11, and they're young enough not to have accumulated wealth, and they can still have donor advised funds.
Exactly.
So, it's in terms of the deductibility. So what it is basically a fund or a pool of money that the donor can advise the charity where to distribute it. So the donor advised fund would give to other public charities at the direction of the donor, but the timing is controlled by the donor. So what people do, and especially following the Tax Cuts and Jobs Act, the notion or the planning idea is that if your giving is not going to put you over the $24,000 standard deduction threshold, what you can do is you can bunch your gifts together. So if you were going to give $5,000 to your church over the next 5 years, maybe you would do a $25,000 gift in year one. For the charitable deduction, you get a $25,000 deduction this year, and you direct your donor advised fund to give $5,000 from that donor advised fund to your church in year one, and the same thing in the next 4 years, but in years 2 through 5, you take the standard deduction and you don't actually take any money out of your bank account and give to charity in that year, but your church is still getting that same $5,000 contribution. It just happens to be coming from your donor advised fund instead of from your individual bank account.
Right. The way I look at that, and I have one as well, and I've had one for a while at the suggestion of my financial advisor, I view that as almost, this may not be the right word, but in an endowment for middle class folks. And the point is, as you just said, and I did this at the end of last year, you pick a number, you literally donate it to the donor advised fund. And that's, in my understanding, it's as if you donated it all that year,
Yes.
but then the money is in your account, and you can use it subsequently to make charitable donations from that entity. I happen to use Schwab. I know Fidelity has one. A lot of organizations, charitable organizations, nonprofit organizations have created them. And I think it's one of the smartest things you can do. And then when you couple that, if you have the ability with appreciated stock, you get a double whammy there. So Kathryn, maybe without getting into the weeds on that, if you can just explain to our viewers how they might do a donor-advised fund and get some additional benefits from appreciated stock or property or whatever.
Sure. We often tell our clients that cash is basically the worst thing you can give to a charity because you don't really get any tax bang for your buck on that. I mean, of course, you get the deduction, but if you are gifting appreciated stock, you basically avoid having to recognize any gain on the appreciation. So you give the stock to the charity, and then the charity in turn can liquidate it, and it being a charity doesn't have to take into account the gain. So oftentimes, most of our clients, and I think this applies to anyone, whether they're high net worth or middle class, if you have, highly appreciated stock that you've been sitting on and you want to make a charitable gift, that's usually kind of your best bet for transferring to avoid that.
And,
Let's
one
go
of
to
the things, excuse me, Craig, and another part of that, which I didn't realize until I started doing this, is, and this may be true for all donor-advised funds, but the ones through the brokerage firms, you can actually select investments.
Mm-hmm.
So in addition to making the charitable contribution in the year that it's done, if you're lucky, your donated money will increase, and you'll potentially get a bigger bang for your buck over time.
Yes. I did want to say one other thing that I think is kind of interesting about donor-advised funds. Y'all may have seen the statistics, but I think at the end of 2017, it was an absurd new number of donor-advised funds were created when, in anticipation of the Tax Act. I think the number of existing accounts, I think it was either doubled or tripled. It was just a huge number of new funds. And so, one interesting thing to look out for is whether the IRS is going to kind of start scrutinizing this. So as listeners may know, private foundations, which are what a lot of people, wealthy individuals do for their giving, they have certain distribution requirements where you have to pay out basically 5% each year. There are no distribution requirements on donor-advised funds. So as you were saying, Robert, you can put money in and just park it. You don't actually have to pay it out to a charity. Of course, that's not the reason why most people are doing this. They're putting in money to donor-advised funds so they can go ahead and pay it out. But one question that the IRS has started looking at is, are they going to put any distribution requirements on these, since the size has gotten so big and so much money has gone into them?
Let's now move towards the concept of transfer taxes, estate and gift taxes. Everyone's kind of scared words. But before we get there, is there any advantage to those people who are at retirement age to donating IRAs or other types of retirement benefits rather than either stock or appreciated stock or cash?
So something that's not new with the Tax Cuts and Jobs Act, but that comes from the last round of tax changes, is the net investment income tax, and which is a 3.8% tax on passive income. So that's pretty technical, but what can happen is if you're over the age of now 72, or if you'd already started your required minimum distributions, so you were over 70 and a half before the end of last year.
And let's take a step back. Let's just answer, why do you say 72 and a half?
So the a law that was passed right at the end of last year, beginning of this year, was called the Secure Act, and it changed the age at which people are required to start taking distributions from their retirement plan accounts. And those minimum distributions, if you don't take it, there's a 50% penalty. So essentially, you're forced to take that amount out, and generally speaking, it's going to be all ordinary income. So one of the options that people have with their retirement plan assets is to do what's called a direct charitable rollover, and you can have assets moved directly from your IRA to a charity. You do not get a charitable deduction, but the reason that you would do this is it doesn't come into your income. So what we were talking about before, you might be taking the standard deduction and you wouldn't benefit from a charitable deduction anyway. So if you were to take it into income and then gift to charity, you might end up incurring more income tax because of the way the thresholds work on, for example, the Medicare or the net investment income tax. So for many people, it can be advantageous to have money transferred direct from your IRA to charity.
So just to follow up on that, to close that loop, so one suggestion might be to have your required minimum distributions, your RMDs, instead of going to you, go to a charity you've designated?
Right. There is a $100,000 cap, but you can do any amount less than that. So, and it does, the direct charitable rollover, one of the advantages of it is it does satisfy your required minimum distribution.
And let's not minimize how important this is. If you don't need your distribution, and so you would otherwise give it to charity or do something else, and you've got up to $100,000 you can give, you're now saving, you're going to be likely in the 35% tax bracket federal, and you're likely, if you're in Georgia, going to be in the 6% or a little less. So in addition to the 3.8 you're talking about, you're going to save essentially 40 to 45 cents on the dollar. That's not a bad tax savings.
You're listening to Wealth Matters, the radio show where we discuss the opportunities and challenges of preserving and managing wealth. We are your hosts, Craig Frankel and Robert Port from the fiduciary litigation law firm of Gaslowitz Frankel. We are talking with Michael Van Cise and Kathryn Baldwin-Hecker, both partners with the law firm of Arnall, Gregory, LLP in Atlanta, Georgia. Our topic today is what charitable advisors need to know in 2020.
So let's go to transfer taxes now. Tell us what the new rule is.
Well, the estate tax has been in flux for a while, and just when we thought things had settled down, they changed things on us. So every individual has currently a $10 million exemption adjusted for inflation, and this has doubled what it was prior to the Tax Cuts and Jobs Act. At that time, it was only $5 million. And our listeners may know that it was only 15, 20 years ago that the exemption was as low as in the 600,000s, and then before eventually moving up. So this has been kind of a slowly increasing number over the years.
What's the current one? So it started at 10. What's the current one now?
The current one is now 11.54 million for 2019.
And for lay people, when us lawyers use the word exemption, what does that mean to a lay person, someone who's worried about, oh my God, the IRS is going to take my farm, my business, my estate, everything I've worked for?
So what it means is every individual can have up to $11.54 million of exemption that they can transfer to whomever they want free of tax. The IRS only imposes a transfer tax on amounts above that. Now that rate is pretty hefty. It's 40%. That's not the highest the rate's been. It's also not the lowest. The rate's something that's kind of changed with the tax laws over time. So let's just say you've got your average Joe who dies with an estate of maybe $2 million. They're not subject to wealth transfer tax. It's not a problem. So this is the estate tax and the corresponding gift tax have become an issue for a very, very small subset of the population.
Do you happen to recall what the statistics are of the number of estates that are subject to this? I don't recall, but to my mind, it seems nominal.
I think it's below 3% that are even required to file less than 3% of decedents even have to file a return. And you have essentially three big things that cause your estate not to be subject to tax. One is the exemption that Kathryn's mentioned. The other is you have an unlimited charitable deduction, so the amounts that you leave to charity also are not subject to estate tax. And the
So
third
you,
big
so
one,
you could fix your problem by saying, I'm going to give to charity everything over whatever the deduction is.
correct.
Yes.
No matter how wealthy you are, you can pay zero tax very simply by designating your a charity to receive the bulk of your estate. And the other big one is the marital deduction. So many decedents, many people that die, don't pay tax because they leave it to their U.S. citizen spouse. Leave the property to their U.S. citizen
And let's
spouse.
talk about that. So if you leave it to your U.S. citizen spouse, you don't pay a tax when the first spouse dies. When the second spouse dies, do they have, subject to inflation, currently an $11.54 million deduction or a $23 million deduction?
Well, there's a nice law called Portability, which means if, in your example, the first spouse leaves everything to the second spouse, you get a marital deduction. The second spouse can also port, that is to kind of take over the first spouse's exemption.
And this is not wine. We're talking about something else.
No, not wine. Just kind of carrying it over, getting to keep it. And there are a number of rules and restrictions related to portability. So it doesn't always work the best for planning purposes, but for most people, you can assume that the second spouse will get to add the first spouse's exemption on top. So basically, you do have that doubled exemption that you're mentioning, Craig.
So the good news is, if the tax laws don't change, you can give, if you're married, up to $23 million subject to inflation away at death. The bad news, I think, is this exemption amount permanent?
It is not. It is scheduled to sunset on January 1st, 2026.
And what does sunset mean?
And sunset basically means that we'll go back to what the law was before the Tax Cuts and Jobs Act. So if you were to actually look at the code, it basically says that this doubled exemption only applies until January 1, 2026. So honestly, that's made planning a little bit more challenging for people who are in the $10 to $20 million space, because right now they don't have a tax problem.
And if it sunsets, what is the number it goes back to?
Well, it'll depend on the inflation adjustment, but I think most projections have been in the range of about $6.5 million per person.
So
basically halved.
So what could we do?
Right. So the two ways to take advantage of the higher exemptions are to either die, which isn't really a good planning option, or you can give assets away. So for really wealthy individuals, the planning idea right now is to sometime before the exemptions go down and sunset, to give away assets to take advantage of the higher exemption.
And let's be real clear on that. What you're saying, if I'm hearing you right, is if you give a gift now, let's say of $23 million or $11.54 million, and it sunsets and goes down, totally good. You still got the exemption. But if it sunsets, you can't give that much.
Correct. Right. So if you gave $11 million on December 31st, 2025, assuming the law doesn't change before then, that would be gift tax free. Whereas if you gave it the next day, you'd pay a fairly significant, what would that be? Several $1 million gift tax if you did it the following day.
So first thing to our listeners, you need to put in your calendar for after tax day, sometime in 2026, I guess, for the 2025, you need to be calling Kathryn and Michael and whomever else you want to call and say, what is there that I could do to make sure things are good? And one is giving gifts. What else could we do?
Well, going back to our topic about charitable planning, I think a lot of our clients we found do have charitable intentions, and when you kind of point out to them that doing charitable planning is basically a means of shifting what you would pay from the U.S. government to charities, people really like that idea. If you're saying this is what you'd be paying otherwise to the feds and you can send it to the charity of your choice, we have a lot of clients who find that appealing, and so we'll do some form of charitable planning, whether it be a large gift, a gift over the amount of the exemption, or just something to reduce the level of federal tax.
Could you use, and I'll call it the wrong thing, but a catch-all that say something along the lines of, I think they're called powers of appointment, but that's so far beyond my pay grade, but where you can say, I'm not sure what the exemption should be, so, because I can't predict Congress, and if you could, you're an amazing person, but I'm going to say anything above. I'm going to figure out a way so that I never pay a tax by using some formula or approach or something. Is there a way to do that?
Absolutely. So for certainly as long as I've been in practice, and I think even before that, because exemptions have changed, you also don't know exactly what your asset mix is going to be at death or what the values of your assets are going to be. So very common in estate planning, certainly for married individuals, to use formulas that oftentimes are based on the federal estate tax exemption. One thing that we've been talking to clients and in our speaking engagements have talked about a lot is with the changes in exemptions. If you had formulas in your will, even if your wealth didn't change, what happens under your document may have changed significantly. So, for example, I have a client. It's the woman created her will not that long ago. I think her will was done in 2012, and she had a formula provision in her will. And basically, to simplify it, her will said, I give a fixed amount to my grandchildren. I give as much as I can give free from the generation skipping transfer tax, which we haven't talked about today, but is another tax that you have to think about. So she said, I give as much as I can give free from generation skipping transfer tax to a trust that was originally created under her husband's will, and then everything else goes to my children. So when she did the will, the amount that was going to go to that trust was around $1 million. Well, of course, fast forward, exemptions go to $10 million, and now the amount that would pass to that trust is about $7 million.
And zero to the kids.
Right, zero to the kids. So what ended up happening is her estate was not large enough to have any go to the kids. So you're right, Craig. Zero went to the kids. And
could you just say that again? I'd like to record that for my wife.
Your wife or your kids?
So this is another planning tip. So when you go back and talk to Michael and Kathryn in 2025 or whenever, and this is an area that Frankel is seeing a lot of issues on. Failure to fix old tax forms is going to result in either unintended consequences or in lawsuits. So one way to do it is to revisit every now and then.
Right. And we recommend our clients do that. We actually reach out to them every couple of years just as a reminder of let's review your documents. It's not that we have to change anything, but let's make sure it still comports with your wishes. And especially in light of the doubled exemptions, we've been trying to push clients to revisit just to make sure that everything still works the way they want it to.
The other thing that I wanted to mention, of course, is that, as you said, there's sort of three buckets you get to choose from for where property goes. It can go to your family, it can go to the taxing authorities, or it can go to charity. And what do you want to have happen? And many people, I think, have used the exemption levels as a proxy for how much to leave to their families. But now that the exemptions are so high, people maybe don't want their kids to get as much as they would get if you take $11 million and divide it by the number of children that they have. So we're seeing lots of people using they're thinking more about how much they want to give to their kids and not letting the exemption amounts drive that. They're thinking more intentionally about what's the right amount for my kids to get.
Yeah, I'm reminded of a quote, I think attributable to Warren Buffett, where he says something like, I want to leave my kids enough so they will do something, but not so much that they will do nothing. Mm-hmm. And the way that you've described the tax code currently might actually, in my view, help push people in that direction, because they've got, if you will, a certain range that they can leave without tax consequences, and they can give away additional money, again without tax consequences, and maybe meet both their family's needs and their charitable desires. I
want to go back to the gifting part. So you talked about you could gift and use up your exemption. Is there other income tax benefits or other benefits to gifting today versus waiting and gifting or making a charitable contribution at death?
So I think the main play there is getting appreciated assets out of your estate, or particularly assets that are likely to appreciate. So if I make a gift of, say, $10 million now, what happens mechanically is I file a gift tax return with the IRS, and it says I made a gift of $10 million, and it uses my exemption. If by the time I die, that $10 million has grown to, say, 15, I'm not going to pay any tax on that excess appreciation. You know, if I've given it to my kids, they get that extra $5 million basically transfer tax free. If, however, I held on to that $10 million in my own name and it grew to 15, I'm going to pay transfer tax on that excess appreciation. So that's another reason why lifetime gifting, especially for very wealthy clients, is very advantageous.
So you can save on the ultimate estate tax just by thinking about this in advance. Are there times in your life, for example, in the sale of a business, when the timing and how you figure out or when you should start thinking about gifting, is there a certain time in a person's life that this is a good time to do it?
So a time that we interface with clients is in advance of the sale of a business. Business owners really have the perfect asset to give away in a tax advantaged way, because if you sell the business, say you sell the business for all cash, so you have a business that's worth $100 million and or that's what it's going to sell for. If you wait until the sale happens, you have $100 million cash. It's pretty clear what that is worth. If instead you give away a fractional interest in the business, the value of that minority interest in an operating business where you don't know whether you're going to get distributions or not will be worth significantly less than the percentage of $100 million that it might represent on ultimate sale. So if you think that you may be selling in the future, one of the planning tips is to give away minority interests in your closely held business over time. There's more complicated ways to do that where you don't actually use exemption that we employ for clients fairly regularly. But so in advance of the sale is definitely the best time to think about giving away property, because it's just much more advantageous to give away a discounted asset in the form of closely held business interest than to give cash after the fact.
You're listening to Wealth Matters, the radio show where we discuss the opportunities and challenges of preserving and managing wealth. We are your hosts, Craig Frankel and Robert Port from the fiduciary litigation law firm of Gaslowitz Frankel. We are talking today with Michael Van Cise and Kathryn Baldwin-Hecker, both partners with the Atlanta law firm of Arnall, Golden, Gregory, LLP. Our topic today is what charitable advisors need to know in 2020.
So we were talking about giving gifts that might help us avoid a transfer tax. If you give a gift today, is there also an income tax advantage?
So really no income tax advantage. Well, sorry, I guess that's a good question. Depends on how you do it and who you're giving it to. So
that's the lawyerly answer. It depends.
So it depends if you're giving it to charity versus your kid.
Correct, right. So if you give the property to your child and outright, so your child owns it, and then the business is sold, the child is going to recognize whatever income tax consequence there is there. So from an income tax standpoint, if you do want to give to charity, one of the things that you can use, sort of going back to our discussion about donor advised funds, you can give closely held business interests to a donor advised fund in advance of the sale. There's a number of things that you need to think about. You don't want to do it too close to the sale, because if you do, the IRS might argue that you still recognize the gain and that you ultimately just gave cash and you're paying the income tax, which defeats the tax advantage. So you want to do it in advance of the sale, but it's best, of course, if you have some some certainty that the sale will in fact go through, because donor advised funds and charities don't really want to have interest in operating businesses. So it's a little bit of a delicate balance in terms of timing, and it's important to think about what you're giving to the charity. Most people don't want to have a charity being able to vote or make decisions about the business. So it takes some planning. It's not something you want to do right at the last minute. Back to income tax advantages or planning. One thing that we often will do with clients is use what's called a grantor trust. And in that situation, the trust is disregarded effectively for income tax purposes, so the donor is liable for the income tax. That, of course, at first blush sounds like a really bad thing. You're giving away assets, but you're retaining a liability associated with them. But from a wealth transfer perspective, it's very advantageous. If you could pay the income tax liability for your children, that would be a really good thing. You'd be able to benefit them. But if if they send you their 1040 and it shows a number and you pay their income tax, that's a gift. In the grantor trust context, because and there's very clear authority on this, because it is your liability, when you pay it, essentially you're making a tax-free gift. So for very wealthy families, business owners, a really good play is to transfer assets to a grantor trust in some tax-advantaged way. Then if there's a sale, you actually pay the capital gain on that, and that's essentially a tax-free benefit to the trust or for your kid. So compared against giving it directly to your kid and your kid pays the tax, if you can give it to a trust that benefits the child and you pay the tax, your child is getting more wealth with less gift tax cost.
Can you give to a charitable type of trust that also gives to your kids in some ways?
So there are a variety of what are called split interest trusts, and those have kind of two different terms. There's a current term and then a remainder term, and you can structure it with individuals either kind of at the beginning or at the end, and charities. So for example, you can do what's called a charitable lead trust, where a charity receives the right either to an annuity or a percentage of the trust assets for a period of years, can't be more than 20, and then at the end of that term, the individuals you've named will receive the remaining assets. And this can also be advantageous from a transfer tax perspective. So due to the way there are many IRS rules on how you actually calculate the gift, but if, for example, you do a charitable lead trust, you can structure it such that you're not making a taxable gift, but if there's any money left at the end of the charity's term, it will go to your designated beneficiaries.
And let me just highlight something that I don't understand, but y'all can explain. What the interest rates are at the time kind of tell you what kind of trust you should use?
Exactly. So there are a number of interest rates that the IRS issues every month that apply to certain planning techniques, and one of those is called the 75/20 rate, and that's basically a hurdle rate for some of these planning techniques, and currently for January it's only 2%. So when you're in a low interest rate environment like we are now, certain planning techniques like a charitable lead trust are very advantageous due to the mechanics of the calculations. Other techniques such as charitable remainder trust, which are basically the opposite of a charitable lead trust, where you have an individual receive the income for a certain number of years and then a charity, those are much harder to do tax efficiently. In low interest rate environments, those work better when the 75/20 rate is higher.
And without getting into the weeds too much, can you explain to our listeners why it is that the interest rates make a difference? Is it because it's treated like a discount rate, how long the funds may last if they're paid out over time, or is there a different rationale for that calculation?
That's basically it. Is there's kind of an assumed rate of return in these, and that's what the 75/20 rate is. So depending on whether, for example, if you put assets in and they appreciate above that assumed rate of return, that can affect the calculation.
So what I'm hearing is, when you say don't get into the weeds, what I really heard you say was, when you have a business event where you've sold a business or you have the opportunity to give to charity, And I do want to remind our listeners that charitable deductions are always unlimited. So you can use them in any fashion you want and help minimize taxes. What you're really saying is go see and talk to somebody like Michael and Kathryn to understand how to do it, and do it early and do it often, like voting. So with that, I would like to ask each of you, tell me one of your client success stories since the Tax Act changed, where because a client came to you early and often, you could go home and say, wow, did I help that client? Give me a good success story. Let's start with Michael.
So with increased exemptions, one thing that we haven't talked about that is important in estate planning is the basis adjustment that you get at death. So oftentimes it's called the basis step up, although that's not.
When you say basis, it means the amount you're going to be taxed on above?
Correct. So the example that we usually give is you go out and buy Coca-Cola stock or some other stock, you pay $100, it appreciates to $200. If you sell it, you're going to pay, on that example, capital gain on that $100 spread. If instead you've bought the Coke stock for $100, it appreciates to $200, you leave it to your child, and the very next day your child sells it for $200 or whatever it was at the date of death, there's no capital gain. So that can be very advantageous. So the situation that I was able to help a client, so a very wealthy family that we work with, their mother was quite old and was pretty near to death. She had a trust that that was created by her husband that was not going to be includable in her estate. That was very good planning when her husband died. I don't remember how long ago it was, but it was good planning then. But now, because exemptions had increased so much, she was not going to be subject to estate tax. So if we left the money in the trust, it wasn't going to pay estate tax, but it also wasn't going to get the basis step up. If we could somehow get the assets out of the trust and into mom's name, then at her death, she, because of the higher exemptions now, was not going to be subject to estate tax, but we were going to get a basis step up. So several months before her death, the trustee distributed those assets out to mom, and at mom's death, they got a basis step up, which ended up saving the family probably several $100,000 in income taxes. Whereas if we'd done nothing, they wouldn't, and there was no estate tax in that situation. So we were able to save the family a pretty significant income tax with that planning, which was very simple. It was not a costly endeavor to distribute the assets, but was very advantageous for the family.
But they had to ask you. Kathryn, tell us your success story.
I worked with a client last year who is a closely held business owner and did the grantor trust planning that Michael was referencing earlier. So this is a structure that I won't get into the weeds on, but it's called a sale to an intentionally defective grantor trust. And so
only a lawyer would say an intentionally defective trust is a good thing.
They're great. They work so well. So this client had a business, and the client knew that a liquidity event was coming down the pike at some point, and basically sold non-voting shares in the business to grantor trusts for the benefit of the client's children. And we did this in advance of the liquidation, so we were able to have the business be discounted for valuation purposes. And so when the business ultimately sold to a third party, the trust that owned shares in the business got a very nice amount of cash, and the client was ultimately able to transfer, I think, about $10 million kind of tax-free to his children through the structure. So the client was very happy.
Good for you.
As we're reaching the end of our show, we'd like each of you to tell our listeners how they might best be able to reach you so they can benefit individually from the great advice and knowledge you have. So, Kathryn, why don't you tell our listeners contact information, website, whatever else someone might need to know to reach you?
Sure. We can both be found on Arnall Gold & Gregory's website, which is www.agg.com. I can also be reached at 404-873-8530 or by email. I do have the unusual spelling of Kathryn, which is Kathryn .Hecker, HECKER, @agg.com.
And Michael?
And my number is 404-873-8790. My name is a little tricky as well. Michael's the normal spelling, michael.vancise@agg.com.
I want to thank everyone today for listening to Wealth Matters, where we discuss the opportunities and challenges of preserving and managing wealth. For more information about Gaslowitz-Frankel, much easier to spell, please go to our website at gaslowitzfrankel.com, and remember to follow us on Twitter at Estate Dispute and use our show's hashtag Wealth Matters. Our guests today were Michael Van Cise and Kathryn Baldwin Hecker, both partners with the law firm of Arnall, Golden, Gregory. Please join us every fourth Wednesday of the month at 8:30 a.m. here at Wealth Matters on Business Radio X.